Hey, so I get questions asked from people all about BRR strategy. So today I had a question that I wanted to answer and share with everyone. So my question is from Ayush Bashal. And they say, hi, so when you refinance and take the money, do you have to pay tax on that money you get from refinancing? Now, this is from the video about purchasing, renovating property, refinancing, and then repeating. So the answer to that is, when you're purchasing property, ideally when you're doing the BRR strategy, you want to use cash. That's first and foremost. However, if you can't and you only have enough for a deposit and renovation costs and the purchase and sell costs, that's fine. You could still go ahead and purchase the property using a lender, but a lender who ideally doesn't charge on early termination fees, because you don't really want to be having those expenses. But it is a lot more costly doing it that way, I think, than using cash, because you're going to have two sets of lender's fees, two sets of broker fees, two sets of pretty much everything. So you want to, minimize that by using cash. However, that's not what the question's about. When you are taking out a loan on this property, that money that comes back to you on the refinance is coming back to you as a loan, okay? It's not coming to you as straight cash profit and you don't have to pay that money back. That money is coming to you as a loan. So not only do you have to pay that money back, but you have to pay the interest on top. So that money would not be a net profit. That money would be money that you have to pay back, and therefore you would not be paying tax on that money. And I just want to be very clear on that. When you're remortgaging, you're not paying capital gains tax on a remortgage, because that money has to be paid back. So it's not a net profit. The only time that you would be paying back, paying some kind of capital gains tax, and again, this is not advice, you go and speak to an accountant. I always advise people go and speak to an accountant. All of my mentees, I tell them speak to accountants for their own personal reference, so they can actually get professional advice. And that's very important, that you get professional advice. But when you are purchasing property and renovating it and taking out a mortgage on that house, that mortgage which has to be paid back, that means that there's a loan outstanding and it's not net profit. Net profit means it's the money that you receive after all of the costs have been complete. So the only time when a situation like that would happen is if you sell a property, you sell a house, and therefore that money that you've sold, you would take into consideration the mortgage. That mortgage would need to be paid off if there was a mortgage on it. Any costs incurrent, that would need to be paid down and paid off. And then whatever is net, meaning there's nothing else left to pay out of that money would then be considered as a net profit, and that is where that's where you would be paying the capital gains tax. So I hope that answers the question for you, that you can understand in depth why that you would not be paying capital gains tax on a remortgage, because it's not cash. It's not a net profit. That is money that has to be paid back. And I think that's very important, that you calculate that and add that into your numbers when you are working out your BRR numbers, when you're looking at a buy-to-let, and if it's a buy-to-let that you want to refinance on later on down the road, that you consider and take those kind of numbers into consideration. You are going to have capital gain tax on rental income that is on net rental income. So once you purchase a property, you're going to have, if you purchase it using a lender or using a loan, you're going to have monthly payments and insurance, maintenance costs and so forth, probably property management expenses as well, if you have an agent managing it for you. You want to take all those costs into consideration. I even suggest adding 5% for voids. Some people say 10% for voids. I don't have 10% for voids. I add 5% for voids, and voids and maintenance issues. And or you can do 5 and 5 for voids, 5 for maintenance. But I collectively do 5%, and you want to add add that all into working out your numbers, whether a deal is a deal or not. Once you've taken into all of those costs, so you have your rental income, then you're taking into consideration the insurance, the property manager, all of those costs, whatever's left over at the end of the month, that is net profit, and that is what you'll be paying tax on. So what you need to now do is include that into any property calculator that you may have. Add in 20% for capital gains tax. I know that number changes up and down and so forth. Well, it hasn't changed for a couple of years now, but you want to add that in for capital gains tax, because it's very important that you're calculating in what tax you would be paying at the end of the year to really get like a net amount, because you have net when you have all your costs, but when you pay tax, there's still going to have to be another net under that for you. That's going to be the real net cost, what you take home. But make sure that your accountant's taking that stuff into consideration. Make sure that your bookkeeping takes that stuff into consideration, and you're putting that money aside every month for you to pay tax at the end of the month. And just, you know, that's really what this video is to embody, is you to understand the costs and what the net profit is at the end of a deal or the end of the month, so you're paying tax on the right amount. I hope this was useful to you. If you have any other questions, be sure to reach out, comment down below, and I'll do a video answering these questions. If you are someone who just doesn't have no time, but you want to invest in property, I'm based in South Wales, I'm looking for joint ventures, let's connect. I'll see you in another video. Bye.